If you were completely new to crypto and wanted to scout out a good cryptocurrency to add to your portfolio, you might head over to a popular crypto aggregator like CoinMarketCap or CoinGecko to see an extensive list of options. Now, with hundreds of cryptocurrencies staring right back at you in the face with all sorts of figures flying around, chances are you will most likely make a decision based on the price of the asset or its recent performance. Now, unfortunately, that alone isn't going to cut it as a good metric to make a decision. And that brings us to the topic of today, tokenomics, which is short for token economics. Tokenomics of a crypto asset include a whole lot of data about said asset such as its functionality, objective, supply allocation, and much more, which key to discovering assets that you are comfortable with and aligns with your risk tolerance and patience level. These details are usually also represented by the token supply, market cap, token distribution, utility, and more. Let's take a look at some of these to have a better understanding of how they can influence our decisions. Let's start with the token supply. Every cryptocurrency has three types of token supply: the circulating supply, total supply, and maximum supply. The circulating supply of a cryptocurrency is an indicator of how many tokens are currently in public circulation and actively being used and traded worldwide. You can think about it like the number of publicly available shares of a stock that can be traded at any time. The total supply, on the other hand, includes the latter, plus any more of the tokens that were burned off. Burning tokens is a mechanism to create scarcity of a cryptocurrency by actively removing a portion from ever being publicly accessible. However, not all tokens have this feature. Finally, there's maximum supply. This tells us the maximum number of tokens that will ever exist in the lifetime of that cryptocurrency. For example, Bitcoin is popularly known to have a total of 21 million coins that can ever be mined, making it a deflationary currency as the public supply can only be reduced. Ethereum, on the other hand, has no maximum supply, making it inflationary. Moving on to the market cap, which is short for market capitalization. It represents just how much money has been invested into a cryptocurrency and is calculated by the current token price multiplied by the circulating supply. Usually, tokens are ranked based on market caps as it represents the interest of the public in the asset. Bigger market cap coins rank higher than smaller market cap coins, but there's a catch which we will discuss later. Next is the token allocation. At the starting moments of any cryptocurrency, there is always an allocation of the token supply to different facets of the ecosystem. Some tokens could be allocated to the early investors such as venture capitalists that were pivotal to the successful launch of the project. Supply could also be allocated to community incentives to keep the core believers in the project actively engaged and happy with rewards. Then there's the public supply, which is tradable by anyone, and sometimes you might even see the core team members have an allocation of their own. There are an unlimited number of ways the allocations can go. So, how do all these figures influence investment decisions? Let's start with the token allocation. Projects that have a large number of tokens allocated to the core team or investors are usually not perceived very favorably by the public and tend to do poorly overall. This is because the investors and team members who are looking to turn a profit on their hard work and investment will most definitely sell of their supply for profits, heavily dumping the price of the crypto and serving as a red flag to the public eye. However, projects with more supply allocated to the public or community are received very well and viewed as heroes of the people that keep their community in mind and of the highest priority. Such projects face way less sell pressure since there are no big players to actively dump the price. Then, what about market capitalization? When looking out for coins to invest in, it might be worth looking for promising projects with good utility that are still low in market cap. This is because the lower the market cap, the more room for growth there is if the project begins to perform very well. However, assets with really high market caps can only go so much higher as their token prices are increasingly unaffordable and little room to scale. And that's it. A brief explanation of crypto tokenomics and how they can potentially guide your investment decisions. We hope you learned something from this VIDE. If you did, consider leaving a like and dropping a follow. Also, tell us in the comments what your favorite cryptocurrencies are for 2024.